Work. Hello.
Yeah, it's recording on there, but yeah.
Super. Okay. Good morning, everyone, or afternoon. My name is Gred Dudley, 2016 grad. I currently work as a senior associate at a private equity fund called Vision Ridge Partners. We're a sustainable infrastructure investment fund. We have about 3 billion assets under management. Before that, after I graduated, I'll just give you a quick spattering of where I've been. After I graduated, I did investment banking at Goldman for a year, West Coast infrastructure. Following Goldman, I did private infrastructure investing at Partners Group out of Houston. Partners Group's I can't keep track anymore, $130 billion AUM fund. After a little bit of Partners Group, I decided I wanted to try and pivot and do something a little bit more generalist. So I did industrial technology investing out of a fund in Seattle called Picture Capital. I was there for a couple of years and enjoyed it, but an old mentor of mine offered me a role at Vision Ridge a couple of years ago, and I took that and have been there ever since. So I live in Boulder. We have offices in Boulder, New York, and London. But anyway, that's kind of my background. So I have a couple of slides that hopefully we don't have to reference too much. Really banking on Q&A today, but for the most part, just want to give you guys a little overview about private equity, what it is, why I do it, why people like to do it. Yeah, but interject with questions at any point. Happy to chat through it. So first, like in a nutshell, private equity is kind of morphed to be a pretty flexible pool of capital. I think at its core, like a plain vanilla private equity shop is a buyout shop, so that you buy more than 50% of the ownership, you control the company, you make all the decisions, you're on the board. Typically transactions are LBOs, so they're structured with a mix of equity and debt. Equity just being your investment dollars, debt obviously being the leverage. And ideally, you invest in a company and hold it for 3 to 7 years, make it better, grow it somehow, and then sell it at the end of the period for more than you paid for it. That's pretty much the goal. Private equity funds, so the actual money that we invest comes from typically institutional investors. So university endowments, pension funds, retirement funds. I wrote down fund of funds. That's a little bit of a nebulous concept, but it's a way for people to gain diversified exposure to private equity funds. So you would invest your dollars into a fund of funds, which would then invest into multiple private equity funds. So just another layer of fees, really, but it's a way to diversify your private equity exposure. And then family offices, which are just rich folks. PE professionals. So we make money in 2 ways. First is what's called a management fee. It's just 2% of your assets under management every year. So simple math. I work at a $3 billion fund. We get 2% of that every year, just to keep the lights on and pay salary for the most part. And then how we make most of our money is what's called carry or investment performance. And that's where you share in investment proceeds above a specified return threshold. So for most shops, that's about 8%. It can be as high as low double digits, but ideally for you as the professional, it's lower than that. But yeah, that's kind of private equity razzle dazzle. Any questions on this one? Alrighty. Okay, so the PE world, I think, is increasingly delineated between what's called a mega fund and then what's called a lower middle market shop. So mega funds are the ones you've probably heard of. These are $10+ billion funds, Blackstone, Partners Group, Carlyle. Massive amounts of capital. The flip side is when you're investing at that scale, there aren't that many opportunities of scale to invest in. So typically your deal flow is characterized by big equity checks, but relatively low deal flow, if that makes sense. I think that's probably all I'd say here. Most of these funds, when you're at this scale, you have investment strategies about every thesis you can think of. So real estate, infrastructure, consumer industrial, private credit, XYZ. Anything on this one? Yeah. So the flip side of that is middle market, lower middle market. That just means you're a smaller fund. Typically,
Size of the bigger market. Where would you put
yeah, it's a moving target, but I'd say 5 to 10 billion probably. So technically, my fund's only 3 billion, but we're probably lower middle market or middle market. The fund I worked at in Seattle, definitively lower middle market. Partners Group, definitively mega fund. The trade-off is, so if you're a lower middle market shop, you are pitching yourself to investors as being able to bring value that a normal mega market or mega fund wouldn't be able to. So for example, my fund in Seattle, we invested in industrial technology, which is B2B tech focused stuff that effectively makes processes more efficient. And our like secret sauce was one of our managing partners, used to be the CEO of this company that made him a 100 millionaire because he was in charge of it and they grew it quite a bit. So then when you go to raise capital, you say, oh, look, we can do this again over and over, give us your money. And that's kind of the pitch. But it's hard to raise funds without a track record. So typically the inverse relationship that I've shown here is typically the smaller your fund, the more difficult it is to get capital. But as you scale and have like a more developed track record, usually your AUM or your assets under management grow. And in doing so, your ability to access capital pretty quickly. Yeah, so those were private equity funds that just, they also happen to be different offices, but that's because they're different companies. So when I was at Partners Group's 100 plus $1 billion, offices all over the world. Effectively any deal that Partners Group does is a mega fund deal, right? They're $500 million plus equity checks, like pretty big companies.
Not
Yeah.
partners necessarily, but just
Oh no, I can.
something
Yeah.
to get heard of, so they can think of, oh, that's a
Yeah.
private equity firm buying somebody else.
Oh yeah. Like, trying to think of a recent one that's good, but because most of mine are infrastructure, which you guys probably don't follow too much. Like Qualtrics just got bought by Silver Lake, right? So Silver Lake's a big tech investor, huge deal, right? Billions of dollars. Qualtrics was publicly traded. It was a take private, so private equity almost in its purest sense. Yeah. So is that a fair response? Yeah.
A big fund buying a company of varying size, the bigger funds buying bigger companies.
Yep. Versus like when I was in Seattle, I closed like 6 or 7 deals, and I guarantee you hadn't heard of any of the companies that we bought. They're just like really small. In the lower middle market, it's more about what's called value creation. So it's how can I make this company more effective? And that might be really simple stuff like an ERP or hiring quality folks in different roles that they just haven't had the budget for. Versus in a mega fund deal, and no offense to Silver Lake, but like Qualtrics is a ginormous company that probably knows most of what they're doing. So a lot of the value added mega funds is more about capital structure. Financial engineering kind of has a negative connotation, but it's really about you're not going to create loads of value in a mega fund deal. It's more about buying attractively in markets with good tailwinds. Fair, maybe a little overgeneralization and probably an insult to Silver Lake, but c'est la vie. Okay. Any questions about the background, or do you guys want to talk about, I guess, how to get into it? Yeah, go. Good question. It totally depends. When you get to deals of that scale, it's harder to trade privately just because there aren't that many people that have the capital to buy a company of that size, right? So if, like, I think it was 12 billion-ish, right? That's what I have in my head. I'm astutely not a tech investor, so you can all fact check me. But let's say in 5 years, Silver Lake goes to sell Qualtrics and it's valued at 20 billion. Like there's a half a dozen people that could buy that company, right? So going public's a pretty attractive alternative there just because it's liquidity. Is that all jargon or is that understandable? Good? Okay. Versus if you're a lower middle market shop, I would say more often than not, you're selling to other private equity funds. So you buy a company, like I bought a company for 15 million. and then you could sell it in a couple of years for 50. And that's very easily traded private equity to private equity, probably too small to go public at that scale. At my current fund, we were the anchor investor in EVgo. It's like the largest electric vehicle charging network in the nation. They're public now, owned by LS Power. Yeah, it's just a way of getting proceeds on the back end for your liquidity. Is that fair? Go ahead. Again, depends. It's however you think you can get the best exit. So we're trying to sell 6 or 7 assets right now, and the public market has a hard time with really complicated assets. If it's not easy to explain the value proposition, it's pretty hard to market it effectively, right? So we're actually leaning towards private transactions for a couple of those, just because we think that's where we'll get the highest value. It's certainly an option, but it just totally depends on the asset. Anything else you want to talk about recruiting?
Talk a little bit about your kind of path there in terms of, I mean, did you always know it was private equity? Kind of when you were here at Utah State, what was the goal? What were you thinking?
Yeah.
I mean, when you were in their seat, because right now they're a lot of thinking, I have no idea what I want to do.
Yeah.
Just walk us through kind of your evolution.
Yeah. I mean, if it's any consolation, there's still days where I wake up and I'm not sure what I want to do, but I go to work. When I was in school, I was probably a little bit of a delicate way to put it. It's a late bloomer. I think you guys are probably more on the ball than I was. I knew I wanted to do finance, and I knew I didn't want to do accounting. Those were pretty much my parameters. So I interned at Goldman in like their operations group, and it just wasn't for me. So I turned down that offer going into my senior year, and then fortunately was able to weasel my way into their investment banking arm. And at that point, I had decided I wanted to do something transactionally focused in like high finance, mostly because I think it's I would say barring being an entrepreneur, it is hard to be in a role where you get to wear so many hats, right? So like in my seat, I do plenty of finance, plenty of legal stuff, plenty of operations. But like you get to do so many things, and that to me was really encouraging. I think it just makes you a well-rounded professional.
Exactly. Explain what you mean.
Yeah. Like buying and selling companies is what I wanted to do. So go ahead. No, you're fine. Great question. Yes. Yeah, that's a great question. Yes, because candidly, there were people who had much better resumes than I did. But for better or for worse, putting in the leg effort to like meet the right people is important. It just kind of is the way it is. Yeah, which is shitty because is unfortunate because that's not like the most glamorous advice, but it is like prudent, right? So I think especially now, and maybe it's always been this way, private equity is a staunchy, like prestigious, rightly or wrongly, that's how a lot of people in private equity view themselves. And part of that is you have to identify private equity as a path you want to do pretty early on. So a lot of people have like internships going into their junior year and internships going into their senior year that are much more relevant than what I did. And I think unfortunately it's just kind of the way the industry's evolved. So you just have to be forward. Is that fair? Yeah, please. It's a good question. I would strongly recommend banking or some sort of investing. I guess put candidly, I had zero transferability from my internship at Goldman to investment banking, right? It was the role I entered in was very much a 9 to 5. Like I'm medium sure a pretty smart monkey could have done my job. And now it's like private equity funds, it's such a high demand role that they can be pretty selective. So the more acutely related your internship is, the better. But to your guys' benefit, there's so much more opportunity in the state than when I was here. Between like Pref and University Growth Fund and Sorensen and like all these things, like it's awesome. But I think opportunities are evolving as the industry grows. Okay, so we'll talk about recruiting a little bit. I would say the most tried and true path in private equity is you do 1 or 2 years in banking and then you become an associate in private equity. That way private equity funds effectively outsource training to the banks. Like my class at Goldman, there were 450 analysts, like tons of people that private equity just doesn't have the scale or the infrastructure to train. And then after 2 years at the bank, private equity will come in and snatch all the good recruits. Other alternatives, though, it's becoming less scripted. So a lot of people do consulting first and then get an MBA and then go do private equity. Or people who are really sharp can do something completely unrelated. And then typically an MBA is a gating way to pivot, but they'll use that to pivot into private equity. So there's more and more ways to get into it. Yeah, go ahead. No, don't be. Oof. All right. I don't want to get in any hot water here. Okay. I'm staunchly against it. So when I was at Partners Group, I was in charge of training our post MBA new hires. So I was like a 25-year-old kid teaching all these 30-year-olds that had hundreds of thousands of dollars of student debt, like how to do my job. And during that experience, I was like, this is the most straightforward explanation for me of why I don't need an MBA is like, private equity is not that hard. It's addition and subtraction, right? Sometimes multiplication. So it's not like you'll learn terribly more in your MBA. I would argue the benefit of an MBA is the network that you get. And I think historically it was more of a requirement. There were a lot, and there still are some funds where there's a glass ceiling unless you have an advanced degree. I very purposefully have recruited around that, and it's increasingly easy to do. Is that fair? Long way of saying it's not a bad choice. MBAs are great. I just think my best friend and the godfather of my children is getting one right now. And he every time I talk to him, he's on a different continent, not studying, and it's like that's fine. Like that's really fun. I just struggle to see the value add sometimes. But anyway, so lots of ways to get into private equity. The interview process is pretty grueling. They typically, because private equity funds are pretty small in terms of headcount, they don't have, unless you're a mega fund, you don't have like in-house recruiting teams or anything like that. So they usually work through headhunters to do a lot of the early screening. So getting on headhunters lists is pretty important. They're the gatekeepers. They'll ask you a couple of get to know you questions about your experience, and then if you pass their screen, they'll hand you off to the private equity fund to actually do interviews. Typically there's a couple of interviews over the phone, and then they'll fly you in for a super day, which is like 3 to 6 hours on site, and you meet with the whole team, and then usually culminates with a model test, which is like they lock you in a closet and say, okay, build us a model in 1 to 2 hours, and then we'll talk about it. So it's a little stressful, but you know what? Diamonds come from pressure, right? So it's not the worst experience. And modeling is just a game of repetition. So it's not hard, it's just stressful. Go ahead. Sometimes you have to push your way onto it. Yeah. Or reach out to headhunters on LinkedIn. I have no idea where they find me. I just get emails every single day. So once you get to a point, they'll find you. But if you're trying to get on their radar, yeah, you reach out to them. Mm. You go ahead. Mm-hmm. Yeah. Yeah, I think, and this might be ignorance on my part, I think the CFA typically is more relevant for like hedge funds. In private equity, they won't scoff at a CFA, but I've never seen a role where it was a predicate, like, or a prerequisite, like you had to have a CFA. That said, Paul talked me into studying for it once. I read all the curriculum, didn't take the test, but it's relevant stuff. More so than an MBA, I would argue. But certainly not a necessity, at least not yet. Yeah. Okay. Anything else on this one? Oh, actually, I should highlight the bottom part. We talked around this a little bit. It is very important to recruit for what you want to do, both in terms of the type of deals you want to invest in and your career trajectory. So there are plenty of funds still where they'll hire for what's called a pre-MBA role. And it's effectively a 2-year contract, and then they kick you out after 2 years and you're supposed to go get an MBA. That's less common, but certainly still happens. So if you want to get an MBA and you want to have private equity experience, that could be a great deal, right? If you're looking for a career track, that's probably a terrible place to sign because you'll be out of a job in 2 years and you know it. Similarly, you can recruit around an MBA if you don't want one. And then every fund is so idiosyncratic, right? They can be focused on very niche investment theses or parts of the globe or anything like that. So just do your homework before you interview. It's not like I worked at Jimmy John's when I was here. It's not like working from one Jimmy John's to a different Jimmy John's, right? It's very much a bespoke investment thesis. Fair? Yeah.
When you said one of the other folks and partners recruited to the current position.
Yeah.
What do you think? What was your value add? Or in terms of why did he pick you?
Yeah.
Over all these other people that he had picked? What differentiated you?
Oof. Maybe he didn't work with enough people. I think it was, we worked pretty closely when I was at Partners Group for about 2 years, almost exclusively on deals together. And I was actually his reference for Vision Ridge. And then during the process, half invited by him, half invited myself just to hop in. So we knew we got along, we worked well together, and then we had a decent track record together.
So not anything technical in terms of it's just more a good fit working wise, or was
it was
technical aspect that was?
I think it was both. So I am a wildly average intellect, right? So it's not like I was an exceptional worker, but I was how do I say this delicately? Modeling is a game of repetitions, and I put in the reps. So I was in charge of training all our MBAs at Partners Group for how to model after they graduated. So there was a certain baseline competency that I think he drew some comfort in, and then yeah, more on the softer side, we just got along. You know. Go ahead. Yes. So carry is what the investment sharing that I mentioned before. That is candidly how you make most of your money in private equity. So I'm currently a senior associate. I'm actually on a little outside this range, and then carry is more than what I make in cash. So it's traditionally what will happen is you'll receive a private equity fund will raise a fund. So let's say you raise $1 billion fund. You go invest it and buy 7 companies, and you sell all those companies in 5 years. If you earned above an 8% IRR, every dollar above that, you get 20% of those, you the fund. And for context, I work at a $3 billion fund, and there are 15 investment professionals. And half of them are associates who don't get carry. So the pie's pretty small, which is why I think private equity is so enticing to a lot of people, right? It's not easy work, but it is abnormally compensated, I guess we'll say, right? Questions on this is probably the most exciting slide. Go ahead. Yeah, so I graduated in 2016, and I only did a year of banking. So I've been on the buy side since 2017. Yeah, and I mean, everywhere I go, I'm like the only kid with a state school degree, but we do the same work, we get paid the same. It's mostly just getting past that first barrier. It quickly came on it. It's really cool transactions, right? Like you get to do market moving stuff. You have like relative to your age and experience level, you get a lot of responsibility. And both of those things were pretty encouraging to me. And then obviously it has to be worth it. So like I work a lot of hours, but depending on the day, I feel like I'm compensated adequately for that. Go ahead. Ooh, great question. I would have started earlier. Yes, that's a great question. I was very lucky that I ended up where I did. And thanks to Ryan and other professors here, you guys are in a lot better position than I was. Meaning there's a sense of awareness, there are more opportunities, like interning at any of the funds in Utah or elsewhere, any investment bank. I think barriers are increasingly coming down where you don't have to be at an Ivy League school or the kid of some big donor or XYZ, right? I think it's becoming more democratized. But yeah, I would have just started earlier, just done more homework, interned appropriately. Go ahead. Yeah. Yeah, totally. What I like about it, so I'll delineate this between the social component and the working component. The working component it's demanding, but it's really diverse, right? So there's obviously at the core, especially as a junior, which is a junior is effectively anything under VP. Modeling is probably core to your responsibility. So it's a lot of Excel, a lot of like digging into businesses and understanding how they make their money, what the key variables are in a business's profitability. And then ultimately how you get a deal done at a private equity shop is you write a memo and you pitch it to your internal investment committee. And those are just the partners at the fund and they say yes or no. So that's probably the core part of my job. Related to that is you meet the management teams, you have to get you have to have some level of conviction in the management team that you're going to back, right? So you typically go on site for the facility, meet the team, learn about their background, identify any red flags, anywhere where you might need to hire to supplement, stuff like that. I mean, the con of it is it's a lot of work. I would say in a normal course of business, I probably work 60 to 70 hours a week. Right now it's much more, which is hard sometimes, right? It's a little hard to plan your life around it, but maybe some of that's on me for not being that efficient with my time, though. I think it could be marginally better, but that's probably the downside. And then the social side's really fun. You just get wined and dined. I'm racing Lamborghinis in Vegas next week. Like it's just kind of fun. So yeah, I don't know. Lawyers like to spend money on private equity clients. So that part's fun. And yeah, and Ferraris. I lied. It's actually in 2 weeks, but yeah, it'll be fun. Yeah, I don't know what they want from me, but I RSVP'd yes, so that should be fun.
In terms of a mid-market shop, is this still kind of fairly typical? I can see like the bigger shops are going to have much more of a delineated progression.
Yeah.
But with 30 odd people,
Yeah.
It seems like they don't want to get too top heavy. That sometimes there's limits in terms of their growth.
Yeah.
So
Yeah, that's fair.
Talk about that a little bit.
Yeah, so it very much depends on the fund. I think every fund that starts out would say they want to grow to be the next like mega fund, right? Unfortunately, not everyone has a top quartile track record though, and it's not always plausible. Which is why, again, I think if you're recruiting the track record, how your fund has performed is like probably the most important diligence you can do. Because if you're at like a very average fund, it's hard to tell investors to give you money when there are 50% of the other funds that can do better than you, right? In terms of the carry allocation, is that partially what you're getting at, or more?
I'm just thinking in terms of career progression.
Yeah.
Do you top out sooner? Do you feel like there's
Yeah.
less opportunity because it's a smaller?
No, it's a good point. I think Certainly not at my shop, or at least that's what they keep telling me. It's fund dependent, but I mean, at a mega fund, at least up to principal, probably there's tons of headroom. They just assume the headroom's there. For MD and partner, it's a little bit more person by person and kind of bespoke. It's probably true at small funds as well, but for example, the fund I'm at, we're investing out of our third fund right now, and we're raising our fourth fund this next year. And the way things are penciling right now, we have a lot of room to go. So I actually think there's no ceiling right now. It's mostly my longevity. Yeah. It's a good question though. You just have to do your homework. There are certainly places where
I guess it depends on that capital raise. If you have a good
exactly
track record and you can raise capital, then you're going to grow.
exactly
And there's going to be opportunities, and if you don't, then
they wind the fund down. Yeah. Yep. Exactly. Any questions here? Go ahead.
In the sense of the example statement,
Mm.
how much demand is it go from basically pivoting from fund to fund? Because it's high barrier to entry to get in.
Mhm.
You're in.
Very much.
You want.
Mhm. Yeah, it's a good question. As long as you're doing similar work, so like I'm an infrastructure investor. As long as I keep investing in infrastructure, once you're in, like you're in, right? It's very like clubby in that sense. And again, getting over the initial hurdle is pretty hard, but once you break in, like my last two jobs, I applied to one place and got a job at that place. Like it's a little easier to lateral. In terms of job security, though, in tepid times like right now, a beauty of private equity is when you raise a fund, your investors commit their capital to you for like 10 years. So sure, Credit Suisse just fell apart, but I still have our investors' money for 10 years, right? So I have pretty concrete job security. So it's much less like a hedge fund or something else where market turmoil spells job insecurity. Is that fair? Hmm. No, I think so. They have reporting rights. So we give them like quarterly statements, quarterly valuations on where we're holding each of our portfolios, and then like our founder writes a semi-annual letter, like Howard Marks, right? If they have questions, they can ask them, but usually the bulk of our interaction comes with subsequent fundraisers. So if you're a good manager, going from one fund to the next, your anchor investors just are in all of your funds, right? So if you're good to say, okay, we're good for another 100 million in your next fund. And that's kind of the sign of a good manager. That's why it gets easier to raise capital, because you have to reach out to fewer new folks. Yeah, so it's yeah. Yeah, no, it's a good question. I actually candidly think I was intending to stay in Seattle, and I think without the backstory, my resume looks spotty. I only came to Vision Ridge because of my pre-existing relationship with my principal. It's probably not the best. You're probably not a great looking employee on paper if you have a bunch of 1-year stints, right? Which candidly is what my resume looks like right now. Right? Bunch of 2-year stints across the shop. The counterpoint there, the way maybe we should talk about carry a little bit more. The way carry works is it vests over time. So they very much want you to stay. So my carry vests over 8 years, but the first 4 years vest 20% each, and then there's a tail for the remaining. So it's kind of an alignment of incentives, right? They want you to stay and you want to stay because you get paid and then they don't have to hire someone else. It's a fair question though. No, that was it. Well, any questions? There are no taboo questions. I'm happy to talk about anything. Mhm. Yeah. Yeah, so I'll actually be VP this summer, which will be great because going from senior associate analyst, those are junior roles. VP and principal are kind of mid-senior level, and then there's MD and principal, and those are kind of the thresholds. As a junior, you are typically you're the quantitative person. As a senior associate, like I'll be on deals and have analysts and associates under me, so I can outsource some of that and do a little bit more VP type work. But I would say the thresholds are really once you cross that into VP and then once you cross into MD. And when you're a VP, it's just execution. So a deal comes in and you just project manage. Like I need to talk to lenders, I need to talk to legal, I need to talk to our commercial and technical advisors. When you're a principal, it's really like relationship management, people management internally, and just kind of like garnering new business. That's kind of how I would delineate the buckets of responsibility.
Did you do a research process and did you use any type of software?
Yeah, that's a good question. Like when we're looking at a new deal, it varies. So we definitely use CapIQ, which is it's an S&P product, and they have everything under the sun, but they have a very specific energy product that we use quite often. Other ones that people use, if you're just doing like early screening and you want to understand like the ownership table of a company, like PitchBooks and Crunchbase and stuff like that are pretty common. But really, because a lot of what we invest in is pretty unique, a lot of the value comes from speaking with experts. So there are these groups called like GLG is probably the biggest, but trying to think of some others, Coleman, GLG, Silverlight, and literally all they are is they have a pool of professionals who are working in the field, and you'll reach out to them and say, hey, I need to talk to someone who knows about this very specific thing, and they'll send you 3 or 4 resumes and then charge you $1,000 for a call. And that's probably how we do most of our initial diligence. Yeah, so in banking, I was an investment banking analyst, so total grunt. Lots of Excel, lots of PowerPoint, lots of late nights. And I actually, because I was in banking for only a year, I actually joined as an analyst at a private equity fund, which is kind of rare, but maybe increasingly common. I think a lot of private equity funds are starting to even just cut out banking and they'll just hire out of undergrad. But anyway, I was just an analyst, so lots of numbers. It was mostly like I knew very little about finance when I graduated, and that's nothing against USU. That's just because going from a book to real life is pretty jarring. So it's really just drinking from the fire hose and trying to understand what the heck people were talking about. Was most of my first 6 months, and then the latter 6, I like to think I provided some value, but you'd have to ask my former bosses. Yeah, so it's kind of a necessary evil, right? Like, and no offense if anyone wants to do banking, it's lucrative. It's just hard. What I think one of the biggest beauties of private equity is recurring income, right? So you have funds for 10 years, you get 2% a year, you get this vested carry, like you have a very delineated set of income. When you're a banker, you can have let's say you had a great 2021. You closed a bunch of deals, you got these fees from these deals. 2022, January 1, you have $0 coming your way, right? So you have to go do it all over again. So banking's a little bit more of an inherent grind because you have to win business over and over again. And that's what makes it hard. Go ahead. Yeah. Yeah, totally. Yeah. No, that's awesome. So I would say every private equity shop will tell you they have bilateral relationships and source things like CEO to private equity fund. It's bullshit. Like every deal is done through an investment bank, right? The bulk of the deals. What happens is a company will say, hey, I want some liquidity, typically a founder. Say, I want to sell my company. So they go to Goldman and say, can you help me find a buyer? Then Goldman will reach out to their Rolodex of private equity funds, say, hey, here's a deal. Here's like 3 or 4 sentences about it. Are you interested? And then if you're interested, you sign an NDA, you get some more information. And then typically the auction process is structured with 2 or 3 steps. So there's a first round bid, which is non-binding. I mean, you have like 50 people bidding on this asset. And the banker will down select to half a dozen after that, maybe 10. And they'll be admitted into the next stage. The second stage is typically, that's when you meet management, you see the asset, you go tour the facility. You get to know more about the business, a lot more granular information. And typically that culminates into a binding bid, called a letter of intent. And then when all these funds submit their letter of intent, in practice, the seller is supposed to down select to a single party. And then you have a 90-day or 60-day exclusivity period where it's you and them, nothing's off the table. You ask all the questions, you negotiate some of the finer points in your legal documents. And that's typically when you get your financing arranged as well, with the goal of closing after the 60 days and owning the company. And then once you own the company, it's yours. So typically private equity funds, especially if you're a majority, like a buyout shop, you'll have the majority of the board. So like one of my portfolio companies right now, we have seven board seats and we're 4 of them. So we make all the decisions, super majority. There's a lot of, you're pretty involved with the companies, but from a strategy level, not from a day-to-day level. So like, I know very little about the day-to-day of what my companies do, but I talk to the CEO every single day, right? And we're talking about trying to get federal funding for some stuff or hiring some consultants to find weak spots in one of our processes, stuff like that. But it's more big picture. It's a great question. It depends on the founder. Yeah, I mean, candidly, I'm going through some management turnover right now that's related to some of that. So it's very founder specific. That is not the goal, right? The goal is there's a founder who loves this company and they understand it better than anyone and we want to work together. And usually those incentives are aligned. I would say most often, maybe a scholar could fact check me, but what happens is a lot of times founders are like brilliant engineers or something like that. They make this unbelievable product, but they're not necessarily business people, right? So that's where I think a lot of the friction comes from is the go-to-market strategy and how to actually scale the business rather than arguing over technicalities of the product. Go ahead. It's a great question. So there are some things that are must-haves and there are other things that are nice to have, right? So must-have is a fine GPA. Depending on the shop, a quality internship is sometimes a gating item. After that, it's all differentiation. So if you're involved in extracurricular activities or volunteer work, or maybe you're an entrepreneur or anything like that, that all matters. We just hired someone who was a classically trained trombonist. That was interesting. So it's just like anything that makes you marginally different, right? But also, as a caveat, don't lie on your resume, because we've had people put like pretty unique things on their resume, and then you ask them about it and they don't have any answers. And it's like, oh, that looks pretty bad. Yeah. So yeah, like club activities are great. It's just like, it's all upside to you to join a club, right? You meet some people, you might pay like I don't know, some registration fee maybe. Yeah, no fee, right? Like it's all upside. You'll never get dinged for being a part of a club.
And the trips and the.
Oh yeah,
There's
yeah.
all kinds of things. what you want to do is have good stories to tell in your interview.
Yes.
Differentiate yourself. They come away thinking, oh, they can remember you. Because
Yes.
you're in a big staff, right, of people. That you're
Yeah,
trying to
that's a great point. Actually, and maybe I changed my answer a little bit. The best thing you can do is know someone. That's probably the very best thing you can do. Because again, private equity funds are so small. Like I've been involved in interviewing since I was an analyst, right? Like it's just the way it is. So knowing someone is critical. Yeah, unless your resume is way better than mine, which is pretty probable. But that would be my recommendation. Yeah. Yeah, that is a harder question to answer than you would think. Yeah, so we day to day, so twice a week we have investment committee. So if you have anything that you're diligencing and want to bring to the committee, you meet with them. Typically there's 3 to 4 stops at investment committee before a deal can get approved, of increasingly granular detail, usually along the lines of how the auction is progressing. Outside of that, yeah, I mean, so right now I'm actually doing no diligence right now, no opportunities. I'm only involved with one of my portfolio companies right now because it's pretty demanding. So I have calls with their C-suite every day. We have a daily call with them. We have a daily call with our consultants. We're having an in-person workshop in DC next week. It's just a lot of, I would candidly say most of my job is project management. So it's, and that can be interpreted as either fairly administrative or who's the guy at the back of the rowboat that keeps people on count? It's just getting people where they need to be when they need to be there, right? So, yeah, a lot of meetings, unfortunately, but and then oftentimes you don't.
In person, traveling.
Both, all of them. Yep.
What's your ratio of travel to in the office?
I'm mostly in the office, but like I think I told you at lunch, I'm on the road like 6 of the next 8 weeks. So it just kind of depends. Sometimes going to conferences to meet people, that's where I'm racing cars. Sometimes workshops with consultants and management teams, oftentimes site visits to meet management teams for companies that you're diligencing, and then in-person board meetings. So that's a really rambling answer to your question. Emails, meetings, modeling, investment committee.
Now that you're senior associate, how much modeling? I mean, percentage-wise, what would you say?
Much less now. It's probably, candidly, it's probably 25% of what I do now. Yeah.
And as an analyst, it's maybe
80. Yeah, much higher. Yeah. I review models now. It's rare that I'm building them from scratch though anymore, which is pleasant. Yeah.
So as you say the work, the hours, 15 per week goes down some.
In theory, yeah. Like as an analyst, it was consistently 80 to 100-hour weeks, like pretty heavy. Now I think anything over 80 is a little bit of an abnormality. Certainly happens, but it's not regular. Yeah, the more experience you get, I would say it switches a little bit from fewer late nights to more travel. It's a little bit more on the road. Oh yeah.
I put a question, if you're like moving up through that position in general, like what we learned here is more like a finance oriented, things like modeling. How do you feel like you got to add value to like big picture?
It's a good question. Oh, that's a great question. Especially as a junior, that's not your core responsibility, but you are certainly welcome to contribute if you have ideas. And candidly, something I would have done more when I was younger. I'm a little bit of a late bloomer in the reading category. I think I was flirting with illiteracy when I was in college. It's like, yeah, just read books. No, just flirting. Yeah. Like just read books. There's so many fascinating books out there that give you perspective. And there are more analogous situations across seemingly unrelated opportunities than you might realize, right? So I've had a goal since, it's pretty mundane. I've had a goal since 2017 to read a book a month, and I do that, and it helps. But yeah, when you're younger though, it's not, they're not going to put you up in the board meeting and say, okay, tell us what we're going to do. That's not, you'll just learn along the way, right? Mhm. Ah, great question. Okay. Favorite books, Red Notice by Bill Browder. It's about, Bill Browder's a hedge fund manager, and he went into post-Soviet Russia and bought up a bunch of like state-owned enterprises, and he ended up becoming such a big force that Putin and his folks killed one of his employees, and now he's back home in the States effectively campaigning against Putin. So fascinating book that's half finance, half politics. Another good one I read just recently is called Speed and Scale. And I'm a little bit of a climate junkie, so this might be more unique to me, but it's written by this famous venture capital investor named John Doerr. And it's effectively just saying, like, here's how many gigatons of carbon we're emitting a year. Here's what we need to do to reduce them. Here's where they're coming from. Here's how we've invested accordingly. It's just kind of a fascinating snapshot of the net zero investment picture. Yeah, those ones are both great. Red Notice. Yep. Trying to think there's other good ones. I mean, there's plenty of good ones, but there's another one it's kind of interesting. It's called The King of Capital, and it's the Steve Schwartzman story. So it's about the founder of Blackstone. And especially for people who maybe aren't intimately familiar with private equity, it's a good place to start. It kind of talks about how one of the behemoth funds came into existence.
A little more specific to you, we could talk about what interested you about infrastructure.
Yeah.
Specifically like sustainable infrastructure.
Yeah. So are we fine on time too?
Yeah,
Okay. So I maintain that infrastructure investing is the crossroads of policy and finance, which those are probably two of my passions. So every investment we make is, like, understanding the policy is as important as understanding the underlying business. Actually, what else did you ask? Sorry. Oh, yes. Yeah. So when I was at Partners Group, Partners Group's not a sustainable infrastructure shop. And a lot of what we invested in was like pipelines and power plants and stuff that are critical, but maybe less aligned with some of my personal beliefs. And candidly, pipelines are just boring to model. They're not that fun. It's like gas comes out of the ground and you pay a toll. Like, that's it. So the climate side of things is really interesting right now because it's infrastructure investing, which typically means lower risk, kind of boring, like infrastructure investing. Core infra is like toll roads and parking garages and stuff like that. Really low beta moves. Climate infrastructure investing is kind of taking a little bit of technological risk against like an infrastructure background. So we still target 20+% returns, even though we're an infrastructure shop. And we're also learning about really cool stuff every day. Like we sold a company a couple months ago to BlackRock that captured methane emissions from like cow manure and turned it into renewable natural gas, and we sold it for $700 million. Like it's just things I didn't even know existed before. Right? It's really interesting tech.
So how important is sort of like policy headwinds and tailwinds?
Yeah.
For your investing, and then you guys think about lobbying, you engage in lobbying?
Yeah, great question. Yeah, so we right now we contract it. But we just hired one of our new partners is the head of the former CEO of the Rocky Mountain Institute, which is like one of the biggest nonprofit think tanks effectively in the climate space. And then we have a consulting firm who does some of the lobbying for us. But yeah, it's like policy is critical to everything we do. So like we effectively, we couldn't do pure play renewable investments until the IRA passed. You just have to like, it changes everything, right? Free money is free money, and you just needed to understand where and when you can get it.
AI. I mean, so
Interesting.
there's always talk about AI and things being automated, and jobs going away or opportunities. Can a computer do your job?
Oof.
What parts of it can? What
Yeah.
how does that affect the PE landscape?
Yeah, that's a good question. I think the front end of any modeling exercise is effectively data aggregation and manipulation. I think AI could theoretically do that. That's probably where a lot of the value add stops, though, because then it's so person-to-person negotiation in the legal docs, or you might have a proprietary view on the market that kind of alters how you're thinking about some of the modeling. And in theory, some of the modeling work streams could probably be streamlined, but and maybe this is ignorance on my part and I'm about to lose my job. I think there's just enough nuance in every single deal that it's hard to replicate.
The way I think of it, they're all one-offs.
Exactly. Exactly.
So you can't really aggregate lots of data across things because everything's a different
Yes.
scenario.
Yep.
You can't, that automation.
Exactly. Exactly. I think that's really fair.
Yeah, any last questions?
Yeah, go ahead. Vision Ridge. Yep, Vision Ridge Partners. Yep.
And I'll put his contact information up, his LinkedIn on Canvas, and then you can, I assume people can reach out.
Yeah. Go ahead. Not a problem. Yes, I just heard about it. It wasn't here when I was a student. Paul has some modeling course,
Yeah.
something 5,000-ish.
Yeah, we have his new one is, it's called Essentials of Financial Modeling.
There you go.
3,000.
Yeah, that's the one.
Yeah.
That wasn't around, or else I just didn't take it when I was a student here. And I had to I found some on-demand video classes that were like taught by some very Indian folks that taught me how to model. And I just did it after work. If you could do that ahead of time, you'd be in a much better spot than I was. Yeah, it's hard. Yeah. But it's just repetition. Actually,
So there's that class, the 3,000 Essentials in Financial Modeling, and then we have another one, a 5,000 level, that's a financial modeling that goes across all of these areas.
Yeah.
We don't teach that one very often, so it's
okay.
we're having tough time staffing it.
It's maybe I retract my prior statement. Modeling is not hard. It's just a little daunting at first, but once you understand how the financial statements interplay, it's rinse and repeat. Like addition and subtraction, cash flows are cash flows across asset classes. It's not that hard. Yeah. Oh yeah. No, it's tricky. It's stressful. And I have like bombed a handful of them, and I think that's pretty normal. I've also reviewed a couple of really bad ones. It's stressful though. It's just an inherently stressful situation.
Okay.
Good.
Uh,
Oh, thank you.